All right, welcome. For anybody new, this webinar is done every week at the same time, usually at 4:15 Eastern on Friday, and I might do them on Thursday in the future just to get the audience that I want. When Friday rolls around, I don't know about you, but I'm pretty tired after trading all week and getting up on Mountain Time now in the U.S. Early in the morning. It's sometimes at 1 or 1 a.m. or something like that in advance of the London Open. So this week required that almost every day to capture the right moves that I wanted. It was a wild week in the currency and metal space, and this is what we have been waiting for, at least I've been waiting for, ever since maybe April when I realized what was actually happening. And gold and silver just exploded this week. Once silver passed about $20, it hit a huge short squeeze, and the banks have been shorting silver for years along with gold. And there were going to be people left with their pants down holding the bag, short all of those futures contracts. So they were forced to cover a huge amount of contracts, especially in silver, which moved silver from $20 to $23 in only 2 days, just back-to-back 7% moves in silver that just were just great returns. And I caught most of it in the gold space, some of it in the silver, but I was not expecting this big of a move in the complex this early before the Fed, in advance of the Fed. So normally this all takes place after the Fed and into August, but it seems like we've really kind of jumped the shark here a little bit on the metals complex this year. So this has a lot to do with the fact that back in March, if you take a look at the spot gold, let me pull it up here. If you look at spot gold back in March, there was the big reset. Let me take all this junk off of here. The big reset that I talk about that's very, very similar to what happened in 2008 October. And this is that huge reset. A massive move down from this year Camarilla R4 that we shorted. That was a seasonal move to short this guy. And then everything got sold off. And now we're completing that move that I talked about way back then, that I thought that, that we could do some kind of an S-wave completion pattern. This guy that I talk about all the time. Once you get a big impulse move at the beginning and then kind of float sideways or maybe drift up a little bit, at the same time, you can expect many times to see a huge move like this that ends somewhat similar how it actually began. And in this case, a massive buying wave to finish this initial buying wave, and this is what we have at the end. And it just so happens that we're about to strike the 2011 high. If we can just go about $20 higher and get there, this is the move that I wanted from the very beginning when I first started talking about getting long gold. And here's the confusion part in here. This is where everybody gets confused about what is gold actually going to do. And in this middle section is the psychological war that will be played on you during this time, where people still think you can short, it's going to come back down, whatever. But the underlying knowledge is that we did this huge reset pattern where everything got sold and everything got bought back up. Everything was sold, including gold, like I talked about in the last week's video, to cover liabilities, to cover people's positions, because they didn't want to have to get margin called on other positions, and people needed to raise cash. As soon as enough cash was raised, people got back into gold. The margins were still high, but people still got back into gold because, they're going to get back into a winning position. This is a winning position to actually long down here at 1450 in preparation for what was going to happen. A couple of weeks ago, I talked about the major dollar reset move that I thought was going to happen based on the past. We only have a couple of data points on a reset like this that has Fed intervention. One of them's 2003, one of them's 2008. And this is 2008. And I talked about this last week where Lehman Brothers crash is right here. And this is the reset where everything got sold. The dollar buyback. And then a gradual decline into the middle of the year of 2009. So this is more of an extended move of what we actually did. And it's possible that that's because of the Fed acceleration of stimulus and MBS purchases that they're doing that is now greater than all of QE 1, 2, and 3 combined is how much they've actually purchased. A little pullback and a last opportunity to short the dollar until the end of the year where we gradually do a decline all the way to December. And you have this initial burst through that low that actually happened. So fast forward to today, very similar pattern. The crash or the reset, the dollar buyback, and then the big decline afterward. And this only took a couple of months to do, maybe 2 or 3 months rather than 6 months. And then last opportunity to short, same thing, right in the middle of June was the last opportunity. And this is the euro, what this idea actually is just exploded this week with the dollar getting crushed based on ECB guidance. The ECB has done something like 300 to 350%, or no, the Fed has done 300 to 350% more in stimulus in dollars versus the ECB. So it's just inevitable that the euro was going to rise against the dollar in a big way. And as soon as this June high was broken by the euro, we just accelerated up to this year Camarilla R4. I tried to short it a couple of times with a very tight stop, and I just kept getting stopped out. I got stopped out twice, and I just gave up because I wasn't willing to risk a lot on this position. So I expect further dollar decline in this big channel that I have here. And we could go even higher than people are expecting. Somewhere that could be maybe all the way up to 1.19. And if this drags on, it could almost get up to 1.12. People would think that that's crazy. But that's right where, what's not being shown here, that's right where year Camarilla R5 is right up there about 1.12, I'm willing to guess. We can actually make sure of that if I just look at this really quick. Let's delete all this stuff. So if we look at these year Camarilla pivots, this is UJ finally capitulated this week, and I saw a lot of commentators that I follow starting to talk about that the yen was the next one that was going to follow the dollar. Can't spell. So if I put the year Camarilla R5 on, which it is on, yeah, right around 1.19 to 1.12. This would be the next target. Some people would think that that's crazy, but it's not actually that crazy considering where the Fed is going with their asset purchases. So something like, this parallel channel, come up here, strike the channel at the same time it strikes the R5. That could probably be the next target. I am not sure. I don't know if we need a pullback. It's really hard to bet against the euro right now, and it's really hard to go long the dollar. It's a falling knife. Gold I got out right around 1860 or so this week, and I didn't capture this last bit of a move, but that's okay because I captured pretty much everything from right around this point, went in, out, in, out, in, out, never fully out, and avoiding maybe 40 to 50 points of drawdown by maybe selling half at key levels, like key Camarilla pivot levels for weekly pivots, maybe the weekly R4 pivots, just like these year R4s, but a weekly, and then buying back in maybe 40 points lower. and managed to hold a decent position through most of this, all the way up to about right here, before we started to get up to this year R5 and started to actually just dump everything. So I don't actually have any gold right now. I haven't been in gold for the last 2 days, but I was in gold for a super long time, all the way back in April, and had to avoid all of the commentary of people saying to short gold, and gold is going down, and we're about to eclipse the non-inflation adjusted all-time high. The inflation adjusted all-time high is back in the 1970s during the Nixon years, where interest rates for the 10-year went up to like 17%. Interest rates are good for gold because it signals inflation. So if we look at, I always visit the seasonality charts every week, because the seasonality charts have been a huge guide this year, not only because we're in an election year, but because they just help you to add another layer of bias towards your actual trades. Yeah, a little bit of connection problems. If people can't actually view it right now, then it will be available later for people to view. If it actually is not, if you're not capable of viewing right now, it's okay. It'll be available on the website probably by tomorrow, when everything gets processed and I can actually upload it there. So hopefully it fixes itself in the next couple of minutes. But I'm just gonna keep going here, because I don't want to Last time I tried this, I'm way up in the mountains, so the connection rate is not the 4,000 bit rate that I actually need in order to do a connection. So this normal 10-year seasonality that I'm showing with the fitted teal actual gold performance in the background is actually showing that we should not have done this big move just yet. This is something you would have expected into August, go out of July, going into August, into late August. So I would have expected this kind of a move later on. So it makes me kind of second guess myself a little bit on where gold is going in the next month. It looks like we did this entire move almost a month early. So I kind of wonder about that, about where gold is actually going to go in the near future. Dow Jones, on the other hand, when we look at, I've been looking at election year seasonality a lot for this year for Dow Jones, specifically this little sell-off that we actually got finally this week that goes into July 24th on average is a little bottom on this yellow profile that shows election years for the past 9 elections. And that kind of, what that does is it tells me that we're kind of having this little realignment moment, possibly, into this little trough, and possibly accelerate through August and into September 2nd or so. September 2nd to September 4th on average, for some kind of a top around the first week of September, and then sell off into maybe October, which is in total agreement with the VIX term structure right now. So if they actually come forward next week with some really dovish Fed news, which I actually expect that they will, and some emergency stimulus by the federal government next week. Next week is such a key week on what could actually happen. So if everything goes to plan, we should get some kind of emergency pandemic unemployment assistance, the PUA, that was paying $600 a week, even though everybody says that it can't happen or won't happen. Let's leave that until next Friday, which is probably the last deadline for something to happen. And let's leave whatever the Fed is going to say, probably super dovish language, given that we're at peak coronavirus and peak fear from the media and peak everything around the country, that they're probably going to have some kind of a language that's going to support the markets. If we don't obey normal election year seasonality, we would actually do something like this with 10-year election seasonality. Give it a second to load here. So 10-year seasonality for Dow Jones, we are way underperforming what that should actually be. And we should actually be, going up, but that's just because of the virus impact with this huge sell-off down here. And again, this is fitted in order so that we can observe the peaks and troughs in the actual profile. So both seasonal profiles agreed that there was a big June 26 buy-in, mostly, right here into somewhere in late July, where we could possibly expect a top. Now, going into the Fed, this actually creates a top, just like how the June FOMC, and in the background I've got in light gray the actual Dow Jones performance on this first axis here. The actual Dow Jones performance, and showing that we did have a peak on this big June FOMC. So it could be a repeat on this July 29th FOMC, where we kind of just drift down and then maybe come back up. This 10-year seasonality is basically showing you the glory years of QE, because this is totally representing 2010 to 2019, which is showing you what have we done during all of the QE years. And this is on average what we would have done. And this is a QE year. We have a brand new QE cycle, just like 2009. So it could be something like this. So we have a combination of things going on here. And we have the reset effect, which during 2009, if you remember, we just kept going up and up and up all the way to December 15th, along with gold and silver. Everything just kept going up all year long with that new Fed stimulus that actually came in. So 3 different paradigms right now to deal with. Are we in a reset year coming into the Fed? Are we in a normal 10-year seasonal profile coming into the Fed, which says we sell off for a couple of weeks into August before we start ramping up again? Or are we in a Dow Jones election year profile, which says that we actually have a huge ramp into September? Or is it none of those? Those are all the things kind of running through my head, which is why I don't really have a big position right now. I have 3 S&P 500 contracts long, and at the close, I zeroed them out by shorting 30 micro contracts on ES to help save myself any kind of news risk over the weekend, which seems to be back again based on all the headlines this week of what we're doing. But we could have some positive vaccine risk news or something like that. So it would be really great if we got a gap down on Monday and we could actually finally fill this. If we look at this 4-hour chart here, actually let me get my other chart over. I've got a chart that I use that's only for gaps. Actually, I'll just use this guy. So this area that I have circled here, if I go back really quick on the day chart, it's circling a retest of this 21 EMA, and it's also looking at this month Camarilla R3 backtest. This is the month Camarilla R3, and I talk about this trade all the time. The sequence is hit the R4, backtest the R3, and then come back up to that R4 again, and then you have a decision. Either the stock is just going to continue to go higher, somewhere around the distance between R3 and R4. Maybe that would be about up to 33.47, and finally fill this February 21 gap that's back here at 33.39 would be that target to actually finally fill that void, which this big rectangular guy right here is actually showing, that that is a big gap target, and we've kind of stopped underneath it multiple times. On SPX spot, it actually shows it more. So this back test would back test this white trend line that we broke through a week or two ago, and it would back test this 21 EMA and this month Camarilla R3. The reason why this area is so important is because there's that gap from July 14th that we still have not filled yet. We haven't even come down to it yet. This gap right here. Almost got there a couple of times, but they just keep teasing this gap, and we have not filled it. And you have to use the close value as the gap, and the real actual official cash close is usually around the 16:15 Eastern time close. So that is what we're looking for, and I would hope that we actually fill that as a gap down on Monday, back test this R3, possibly back test this trend line, maybe all the way down to 31.55. If we go any lower than that, it gets dangerous. So we don't want to go lower than that and break through this trend line again, even though other indices actually did this. Russell 2000, not so great. Broke through that same descending trend line, went up, hit that R3 monthly, came back down again, broke down through that same trend line, and now it's contending with this parallel channel that we've been traveling in for months. And if it breaks down below that, this could end up very badly, and we would probably come all the way down to here to retest this June low, all the way down to 1319 or 1320 or so. That would be worst case scenario. Dow Jones, also not that great. Cannot pass this descending trend line. It's tried multiple times. Each time it hits it, tried again and rejected. And if it needs to come back down to the 50-day at the lowest, then that could be another place to gather more momentum to actually try to attack this trend line again. But it doesn't look so great. So we're in kind of this weird spot right now where it could get bearish very quickly, but it could also still ramp back the other way and get bullish very quickly. So it's just kind of a testament to where the professionals have put the price to confuse the most people, and the most people to get burned on the upcoming trade. So 50-day has still not crossed the 200-day for Dow Jones, but it has convincingly for S&P 500 a week or two ago. It actually happened. So this is constructive momentum on the moving averages in going forward in the future, walking this forward. Let me see what the connection is. Well, the video is always available later on because I'm way up in the mountains right now for the next couple of months, and so I'll have to just bear with the connection problem to actually stream at 1080p here. So this is what we're looking for in the future. I keep coming back to this profile that I have for yield rates, and what I have here is I'm showing this divergence of SPX or S&P 500 futures continuing to go up while the 30 minus the 2-year spread continues to go down. You can see, like, during the previous couple of weeks, they kind of ran together, which is bullish. And when they start to diverge, eventually you get a problem. So here's a couple examples. If you go in the past, you can see the divergences eventually led to a large sell-off in the markets. And the longer the divergence actually happens, the deeper the sell-off. So sometimes it has a small sell-off, realigns itself, and then they start flowing together again, but you never really know, and this is just, another confusion aspect of where we could actually be going forward. If we look at silver, Silver had such an insane move that I honestly think that this rally killed the move here. Spot silver had such an incredible amount of volume um, during this last breakout that happened this week. Once we started approaching $20 on futures, a little bit lower than that for spot. But this 2019 high really kicked it off back here in September 2019, and then the short covering started to happen, and you have this explosion in volume. On the day chart, if you actually check the value of the normal 14 RSI, we hit 88.5 this week, and that's a level that if you zoom out on this and go all the way back to say 2011, and we go all the way back to here, we have not seen a level like that since April 2011. And if I zoom in on what these values are, we hit right around here. And I said 88.5. So this level was hit on April 21st, 2011, right here. This guy right here. When silver was going insane and it hit, was approaching $50. This is right where COMEX decided on CME to actually raise the margins to double or triple for silver. And I remember it was up to like something like 25,000 a contract at one point. The overnight margin is all the way down to 8,000 now. It probably should be lower, but you know, well, actually not. Silver kind of moves in crazy sometimes, and you can lose a lot of money really fast or gain a lot of money really fast. So it did go a bit higher here, and we got another high on the RSI, but not by much, 89.5. That was the highest RSI we hit the next day, and then it never actually got higher. And a week later, the bottom dropped out, and we corrected something like 25 to 30%. So we have not seen this level of RSI in a long time. So I almost want to say that we need to come back down to this 2019 high, and at the most come back down towards the 2019 close area on this descending trend line, and actually retest this to gather steam again, because this is unsustainable. This is another one of those S waves that I talk about, where you start out strong, but the move on the other side was actually a lot more than it should have been, but it still qualifies. You know, you have this huge initial move, and then you have kind of a sideways movement, went up, it crossed up, came back down, and then another huge move up. So something like this is just, I refuse to buy into this. I need it to come back down at least $1.50 for me to even consider getting into some micro long silver. But we'll see what happens on this. But I'm not trying to get into it. Shorting is also dangerous because you just never know. It could just pump up to 24, fake everybody out, and then dump immediately after that. Shorts forced to cover, longs forced to cover. Everybody has to cover, and then it comes back down again. Silver, in the long run, I'm extremely bullish on. After it penetrated this January low and then came back up, these were levels not seen in a long time. Not since 2008, 2009 area were these levels seen, when everything got sold off, and now we're above all of it. So this is totally bullish price action and should last a very long time. If anybody tells you different, I don't know what they're smoking. The dollar is descending into hell, and we're printing faster than ever before. And this isn't me being like a Peter Schiff or something like that. This is just like inevitable. We could approach 8 trillion by the time the year is over, and not even bat an eyelash. So doing cumulative MBS and Treasury purchases equal to QE1, 2, and 3 combined is just, it's a no-brainer on the dollar. I posted this last week what I was talking about when I was talking about asset purchases. And thanks to Ari again in the group for making this. If we go back to 2008, if I put on 2008 to today here and show the actual Treasury and MBS purchases, you can see exactly where the tops are in S&P 500 futures. And it usually corresponded to either a top in the mortgage-backed securities in orange or the U.S. Treasury purchases in yellow. And you can see this on Fred or St. Louis Fred or the New York Fed's website. You can see all of this stuff. So usually a relative top will happen when one of these is topping out. So here was the top of QE1. Here was the top of QE2 right here in 2011. And this was a little baby head and shoulders pattern that you can see right here on this weekly chart. And then the right shoulder happened to be right when this was about to taper off. And they front ran this whole thing and sold it off 20%. Operation Twist happened somewhere around here, or maybe it was later in 2012. I can't remember. Flatline for a little while and then ramping up QE3. And look at the steadiness of the, by comparison, a direct correlation of the slopes of both with MBS and Treasury purchases all the way until they started to slow it down. Then the market kind of drifted sideways, slowed down, had another 15 to 20% correction in 2015, and then started to ramp up after the election. Here's the 2016 election. And this is the first time that the stock market rallied since 2009 without federal intervention. Here's only a year later when the Fed was like, hey, look, the market's rallying and we didn't have to do anything. Let's start selling the balance sheet. And people thought this time is different. No, it's not different. Market rallied for another 1 to 2 months or 3 months into that big January capitulation. And this is another one of those big S waves that started with 2016 commodity bottom and then a capitulation up to the January top in 2019 or 2018. That was where Bitcoin hit 19,000 and died and never got back again. And then we got all this crazy movement, and the Fed had to give up. Powell capitulated right around here in late 2018. And then we had the big rally, and here's where repo started when we started ramping back up in September of last year, and repo intervention happened, and then the craziness happened. Here's the crazy. This is when MBS went and Treasury purchases went vertical, and as we go to what everybody says, infinity and beyond, which is just QE infinity. So we have not slowed down yet. We are still at a slope. If I look at this slope right here, this slope of Treasury purchases, oh man, okay, I can't actually do it because I'm trying to hide all these drawings. The slope of Treasury purchases currently, if I just took the tangent line to this guy, it's still greater, if not, equal to QE3, and MBS purchases kind of the same. So this is why I lean towards the election year DJI seasonality idea, because we haven't stopped buying yet, and I am not privy to any time in recent history, even back to 1998, where a market top happened in a bull market when there was without a top happening in one of these two purchase programs that the Fed does. So that's kind of why I remain bullish on this, and that's how we were able to call all of these tops and bottoms and stuff along the way when we were trading S&P 500 on the way up, all the way back since April through May, all the way to June. We've been nailing all of these things all the way up and all the way down using seasonality and a couple of other guessing things on what the Fed was going to say. And, it seems complex, but if you have the right tools, you can actually get by very, very well in order to navigate these markets and eliminate a lot of the noise. So going into next week, these are kind of my plans for what I'm looking for. And it's going to be a huge determining moment on what to expect coming into the markets next week. So I don't have, let's see, oh, there it is. I was looking for this chart. We keep coming back to the dark pool levels that I talk about. And for the entire month of June, we were bounded by these two huge 40 million dark pool level and 53 million dark pool levels from the past. And this was one of the ways that we were able to short that June FOMC top. Was we saw this and said, you know, the amount of energy it took just to get to this place, I'm going to short that, and I'm going to go to bed. I'm going to go to sleep at night and not even worry about it. And we did, and we shorted it. And then we bought it all back somewhere around here at this 53 million level. And we started to short again over here. It hasn't been working out. We moved above this, which should have been a very bullish sign, but we actually closed back below. So it's going to be really tricky going into the next couple of weeks, whether or not, or the next week, knowing whether to long or short. But these two big dark pool levels in pink are something very important. If we can go higher, the next big one is at the 332 level, which is right around where that February gap is for February 21st. Well, we've never actually come back through yet. So we'll see if what actually happens. I don't normally go into stocks themselves, but AMD is just worth talking about. This thing keeps getting bought. It's insane how much this thing keeps getting bought, but the Dark Pool app shows all of it. And I'll pull it up here. So if I go into the Dark Pool app and I actually show this, so if you communicate with the bot and you do something like the block summary for, which will include both live and Dark Pool blocks for AMD for the last 60 days, you're going to get something kicked back from you from the server that I'm parsing all this information for the last year for everything. And we have just had unprecedented buying in AMD. So the little green heart guy shows the percent that we are actually above the block level, which is the price here. So that's what this little triangle is, the delta. We're 3.4% above this 6707 block price, where there was 510,000 shares. This is all in thousands of shares bought, apparently. And today was an interesting day because this little dot right here means it was a dark pool block, but it was a same day late dark pool block. And what does that mean? That means that at some point where this 510,000 share block happened at 6707, somewhere, let's see, somewhere back here. 6707 was somewhere right about here. And it didn't happen until later. We didn't actually see it on the tape till maybe over here. So they delayed it by maybe an hour or two. So it's an out of sequence block, meaning that it hit the tape and it's nowhere near the current price. It's impossible. What they did is they used the dark pool machine to hide the trade only for like an hour or two before it actually hit the tape for everyone to see. So usually that means that they're so eager to buy that they're willing to use the dark pool machines to actually hide the trade on like Sigma X or whatever the big dark pool machine that they're actually using. There's like 40 different exchanges now that they're actually using. So this block that they did would further signify that there was going to be additional buying pressure today. And I set the target for this up to about the 1.68 extension of this guy right here. So that seems like a good move. And if you go back in time to the bottom in, let's see if we can do log chart. If I do a log chart on this, let's change it to week. a log chart, if you connect these lines down here, we've been traveling underneath this trend line for some time, and every time we hit it, we just keep going higher and higher. So this is just yet another bullish breakout, and this was just an insane week. This is an insane weekly candle. So really great. I think it can go even higher. It looks like we had a breakout above this February 2020 high and then a back test kind of for the next day. Huge volume. This is exactly what you want to see on a breakout. You want to see massive volume on a breakout and earnings next week on July 28th. So probably buying into that earnings, and we'll see what happens after that. But if anybody was attacking these blocks that have been happening, and I'm only showing a couple of these dark pool blocks, the last three big ones, but they've been buying all the way since May 4th. May 4th is 36% ago in this stock, way back here somewhere at 50.07. So May 4th, somewhere around there, where they were buying every single time they could get. They were buying all in this band right here, in this 50 to 52, 53 band. They were buying in this level. So in the future, this will become incredible support in this area because of all the buy blocks that actually happened from 50 to 53. They just kept buying in this area over and over again. So following the dark pool blocks is actually really important because it shows you what the major players are actually doing. And there's some art form to it to actually guess on what they're doing to figure it out. But once we started moving up towards this high, you better believe that they're going to punch it through, and people got short squeezed on this one. So really great trade. I know some people got a piece of it in the chat group, and I expect it to go up to this 73 to 75 level, possibly next week or at least into earnings. They're probably going to keep buying into it. All right, those are my thoughts for next week. It's going to be a really interesting week, and there's going to be plenty of trades. Still a lot of earnings. This week was a lot of earnings to actually talk about, but there's much more to come, and there's great trades. I really hope that the DJI seasonality thing actually works out, because that would just be a great trade that you can just hold to September and feel good about it. And you're going to know that the trigger happens if we backtest this, hopefully on Monday open, and then have another turnaround Tuesday. If we break above these highs near 32.80 or 32.90, then I think that that's the signal that we're actually going to do the election year seasonality. And then that opens the door to this February 21 gap and all the way up to this year Camarilla R3 pivot up where this big two extension is from the bottom in, I think, like 2008 or something like that. I can't remember. Something like, I think if you, I don't know. I don't even know what that comes from, but I know it's important. I'll have to figure out where that actually comes from next time. But stuff to look at. The moving averages are still very constructive. 50-week, 200-day, 50-day, 21 EMA, everything moving in the same direction. If we can get another retest and some positive buying, I suspect that we can have some follow through. But be prepared for the opposite, which could show a further breakdown. And in that case, the major thing to short would probably be Dow Jones, because this is just not very good. If we're going to have a little consolidation in this area, it's slowly reaching the point of no return here, and it's not. It just won't go well. If we cannot clear this area and move back up higher, there's a possibility we can just descend and come all the way back down here and test this area and the 61.8% retracement level again for the entire virus correction. Oh man, I'm sorry. I had this Telegram thing on the entire time. What I was talking about was Dow Jones would be the thing to short if we cannot pass this area. And this guy right here, it just won't go well. and we would possibly come back down to 25,000 level. So S&P 500 is the major thing to look at next week. Need to retest this month R3 somewhere around 31.75 and then kind of go higher into the Fed. The Fed is key. Whatever the federal government actually says is also key. And expect some headlines and some crazy emergency all caps headline maybe on Thursday or Friday, the day after the Fed, that saves the day and we actually go back up, or it doesn't happen and we come back down. Not sure. There's be prepared for anything. I'm still long bonds. Oh yeah, bonds. The last trade that I wanted to talk about. Bonds, no matter what, have a win going into next week, in my opinion. Bonds is something I've played in significantly this year, probably more than any other year that I've actually traded bonds, this year especially because of what's happening. So bonds have this little pullback usually right before the Fed also. So these big capitulation moves happen on FOMC dates a lot of time, especially the quarterly FOMCs. Like this June FOMC was a great time to buy bonds, and I got in at the lows down there. It was just a great trade, and you could have held this entire time and followed the seasonality profile for 10-year seasonality. And this is the best trade of the year for bonds typically for the last 10 years, especially during a bond purchase program where somewhere right before the Fed, you actually long into the Fed and ride this crazy rally up into late August. So that is exactly what I am doing. I'm currently long 2 ZB 30-year contracts. And if all goes to plan, this should actually accelerate maybe up to 185 or something like that. If I actually turn on the pivots in the background, this year R5, let's see. We're already at year R5, so we would actually go even beyond year R5 and up maybe to 185, 186 level is something that I can actually consider as a realistic target. But this is going to be a great trade. I am definitely going to take advantage of this trade coming into the next Monday or Tuesday session and maybe long 1 or 2 more contracts so that I can capture this move. I've been waiting for this move all year, but I have been in long since June 10th, June 9th, capturing this move and going in and out along the way. Okay, that does it for the trades for next week, and I think that if you're taking advantage of a couple of these, you should be well prepared for the coming week. All right, good luck and have a great weekend.